Our time now for Retirement Ready, brought to you by Fidelity. Today we are joined by Will Rhind. He's the CEO at GraniteShares. And Will, let's talk a little bit about finding income in a portfolio. You say that income as we once knew it no longer exists. What exactly do you mean by this? I think we all appreciate rates are low and it challenges a lot of different parts of portfolio construction. But as you think about it, what do you mean by that statement?
Well, it really just means it's, I suppose, tongue-in-cheek at some level, but this is actually no laughing matter that we've had interest rates low for so long. And just when we thought that interest rates probably couldn't get any lower, they did. And they've now gone to officially zero. So for the retiree or for the investor looking for income, this COVID panic that we're going through has just made it even harder for anybody to access income. And so that's what we mean when we talk about, income disappearing at that level we've not seen.
Yeah, and so I guess, along those lines, there was definitely a sense in the last decade that it was, zero rates were a temporary phase and that perhaps we would normalize. But I don't know how you're thinking about this, but it does seem that we've now codified in many ways that rates are going to be low almost indefinitely, and that it really, if you were waiting to go back to the old 80s, 90s playbook of how you generate income within a portfolio, that thinking needs to be done away with. That's probably never coming back for the investable life of most folks out there right now.
Yeah, and look what happened when the Fed started to raise interest rates. And we started to raise interest rates here in the States to somewhat of a normal level, but the bond market effectively freaked out when rates got to a certain level, and so the market or the government backed off, and we've got rates now that have gone back to zero because of the crisis. So it's really challenging for people, and going to be more challenging now looking for income. I mean, the amount of debt that we have, here in the United States and around the world is just too high for governments to start raising interest rates and getting things back to normal. I think the only way that happens, you're talking about the 70s, is that you would get a inflationary style environment like we did in the 70s. And the only way to kill it is by raising interest rates. And we hope that doesn't happen, obviously.
So GraniteShares has a U.S. High Income ETF, and there's REITs in there, some MLPs. What maybe people had thought last quarter could be stable, constant income, is that now in question? I mean, let's just start with the real estate part of it, which, we've been hearing about people not paying their rent in offices and malls. What does that do to the ETF?
That's a great question. So the actual income itself has been stable. And we're talking about, our ETF, the ticker code HIPS, HIPS, and HIPS stands for High Income Pass-Through Securities. So this is like what I like to tell people is that it's one of the benefits of investing in a broad, diversified index, whereby you have multiple companies in the index. In this case, we've got 60 companies currently yielding just over 12% per annum. And the amount of income that's generated is distributed on a monthly basis to investors. So you have a diversified group of companies in there. We have MLPs, like you said, who are in the energy sector, you have REITs, you have closed-end funds, and you have business development companies. So the idea is to try and spread the risk and diversify across multiple companies, so trying to deliver consistent income over time.
Thinking about the humans involved here, the individuals who are trying to retire, who are planning to retire over the next couple of years, are you getting a sense that this concept in its entirety is kind of being redefined right now, that people will have to stay in their jobs for longer in order to afford a nicer life down the road, especially with a lot of the gig economy even shuttered, right? And a lot of these gig workers who are working extra hours, a lot of it is manual labor, whether it's going through a grocery store and doing the errands for people who have the privilege to afford those services. How are you thinking about the future of retirement in this current era?
Yeah, I think the future of retirement is very challenging at this particular point in time, and I think will be going forward for some of the reasons that we've talked about. But I think one of the key things is that there are mechanisms for people to obtain income in this environment. And one of the reasons why we have a monthly payment or monthly distribution for HIPS is that people obviously need to pay bills on a monthly basis. So we need to try and coordinate the ability for people to raise income with the day-to-day bill-paying activities and regular activities that they sustain. But you're absolutely right. I mean, I think before this crisis hit, we were talking about extending the working life of the average person. People working longer, maybe working multiple jobs, and in the gig economy, you saw a lot of older people working different jobs for that precise reason. And I think clearly with rates now back at zero, that's only going to get more intensified.
And then, Will, quickly before we let you go, just want to ask a little bit about your outlook for gold right here. It had a huge year in 2019. We have seen the price of gold come to life a little bit in the last couple of weeks after selling off with pretty much everything back in February and March. But just thinking about where gold fits into a portfolio and the conversation around gold, which was sort of a joke maybe 3, 4, 5 years ago, but I think really kind of became a lot more serious in the last 18 months.
You're absolutely right. And again, I think about 2008, the last time when we had a panic like this, and anybody that bought gold in 2008 did really, really well over the next few years. The gold price doubled over the next 3 years after 2008. And really, it was a combination of extreme money printing from the Federal Reserve and concerns about the integrity of the stock market more broadly. I think this time, actually, I mean, I hate to say it, but I think that we have a worse economic situation than we did in 2008. We have a monetary response which has been bigger than we saw in 2008. I mean, just some of the stimulus packages alone have created the same size as economies such as Italy or even bigger in Brazil. And so we're printing a huge amount of money. And I think this time around, the reason why people are buying gold is because they're worried that the amount of dollars that are being printed will debase the value of the dollar, the currency, and therefore people want a store of value. So people have been buying gold pretty aggressively.
All right, Will Rhind is the CEO of GraniteShares. Thanks so much for joining us. We'll talk to you soon.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.